Hey everyone, this is David Trungale here from TraderTours.com. I appreciate you guys watching my YouTube channel, and today I wanted to have a discussion on investor psychology. We can see here there's a quote from Nicholas Darvis, who is one of the greatest traders of all time. He stated that when emotion and logic collide, emotion will always come out ahead. So I wanted to illustrate this by breaking down a market cycle that includes a bull market followed by a bear market and display what most people are thinking. And you have to remember that the crowd is usually wrong in the world of investing. So in this case, I have used the conglomerate index of the 1960s, and then you can see the bear market here occurred over like a 2-year span, give or take. And in the orange text, we can see what most investors were thinking. Now, this model will work on any boom or bust. You could use the '08 crisis, the commodities bull market of the 1970s, the dot-com bubble, whatever. In, again, virtually every case, you're going to have the same basic psychology here, which is driven by fear and greed. So if you look at the early 60s here, when this bull market really began, this is when most people were in a state of denial, or they simply failed to recognize that this was the beginning of a bull market. And as the bull market progressed, you will have people start to believe that it is in fact a bull market, and then once we hit the apex, or in other words, once the market tops out, this is precisely when people are totally sold, and they have total belief that this market is going even higher. If you look at the y-axis here, it was right around 700, and I would be willing to bet you had people out there claiming that this index was going to soar over 1,000 or 3,000 or whatever. Now, as the market reverses and as we enter the bear market, the same people that were in a state of total belief here are now in a state of denial. You know, they're still sold that this is a bull market, and as the bear market actually progresses, they finally reach a state of belief, usually somewhere towards the bottom. So if you look at this model and think about what the investor sentiment is like, if you want to be successful, you actually have to embrace the exact opposite of what your instinct might be. So if you substitute each of these words for an antonym, you can see how profitable this would be. For example, instead of being in a state of denial here, maybe you should be in a state of belief. You see a market trend that is progressing upwards. You see 52-week highs being penetrated. That can be a bullish signal. And then when most people are in a state of total belief, this is exactly when you should be the most cautious. So Warren Buffett said to be greedy when other people are fearful, and fearful when other people are greedy. Well, even though I'm not a fundamental analyst and I certainly don't agree with everything he says, I think that quote is quite accurate whether you're applying technical analysis or fundamental analysis. So the tip here of the week is to consider embracing the opposite, reverse your instincts, and you may be surprised at how good the results are. Thank you for watching.